Boom. Boom, boom. All right, let's get this going in here. Keith Whitley. Go live. I think it works. Let's see if she works. Are we working? Are we live? Are we live? Maybe this is off. 1 second. Hello? Oh, yeah, it's on. Perfect. All right, Tradecaster. Boom. All right, let's see what we got. Where is Buddy? Let's talk about where he is real quick. Jerome Powell, where are you? YouTube live. Give us 1 second. Jerome Powell, baby. What up, buddy? What's up, Jofi? Hold on, give me 1 second. I'm trying to pull up this. Here we go.
At L'Oreal Group, 78% of the PET plastic we used came from recycled sources in 2022.
Can you hear that? I'm hoping. It's kind of loud, too.
This is how we create the beauty that moves the world.
Early on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing. And we
Same shit every time.
Committed to bringing inflation back down to our 2% goal.
Notice how every time his hair is a little bit
Price
more
stability
fucked
is the
up.
responsibility of the Federal Reserve.
He's a little bit more stressed.
Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending.
Can you hear him, or is it too faint?
Activity in the housing sector remains weak, largely reflecting higher mortgage rates.
Chat. YouTube
Higher
chat.
interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year, Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2%
All right, we're back.
is a long way to go.
You got a plan for a trade
Despite
after this?
elevated
Or are you
inflation,
going to sign
long-term
back?
inflation expectations appear to remain well.
I don't have a plan for a trade
as
just yet.
reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power.
Oh, God. It's the same shit
especially
every time.
For those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightened over the past year or so in response to our policy actions and a softer economic outlook.
Going SPX over here.
But the strains that emerged.
I'll load up some puts just in case.
Appear to be resulting in even tighter.
A weird feeling we're going to that 408 level, which would put us well below 4,100.
In turn,
these are pretty expensive still, so be careful.
Conditions are likely to weigh on economic activity, hiring, and inflation.
I'll go 4080s.
Extent of
a little bit of
these effects
time.
remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. But we are prepared to do more if greater monetary policy restraint is warranted.
Damn, look at that drop.
We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
I could literally tell you this whole speech without listening to him.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here's where the heat comes, baby. Let's go. Flame his ass.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June.
Ooh.
And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question.
He prints every time, switching these to calls.
So the staff's forecast is so. Let me start by saying that that's not my own most likely
115 to 470,
case, which is really that the economy will continue to grow at a modest rate this year.
What a rat bastard! Every year, every time.
Different people in the committee
zooms.
Forecast. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly.
I'm going to go on real light on a call here. Real light 340. I'll stop myself real fast, though, if it goes down.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the
very risky, so not very many
of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policies.
No volume here.
And they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. Failure to do that would be unprecedented.
Doesn't feel like a moonshot now. Feels like a little bit more of a
to the U.S. economy
chop fest.
Highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential
quick 120 out
long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S.
I guess it didn't even stop me out.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks.
At a 130 loss there?
And that will come
140?
A number of people did raise that as a risk to the outlook. I wouldn't say
just one contract, though, no worries.
Monetary policy decision, yeah.
Just feeling around until we get some momentum.
Thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about that I recall anyway about the risk of a bank run. So it was. I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think
real choppy, guys.
Many banks are now are attending to liquidity.
Looks like it's just going to bounce back and forth.
Taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think in this particular case, we have found that monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities.
I haven't done anything. I had one contract that I got stopped out.
Use our monetary policy tools to foster maximum.
Not taking anything heavy just yet, till I see a direction.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role. So I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more.
I can't seem to get in on anything right now.
So given developments since then, how has your estimate changed?
I should probably go closer to the money. These are pretty cheap.
I think I follow that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been
looking at 4160 calls right now, it seems to be holding up on this VWAP and this bond and Bollinger Band. I'm gonna wait for this rat bastard to stop talking, though.
And
I feel like that'll help us out a little bit more.
Standards that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made as that would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level.
I just
rate.
switched to 4155 calls.
We'll revisit that at the June meeting.
So we'll see what happens here.
And that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned.
Damn, this thing, every time it dies.
And a follow-up on credit, if I could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this show, and how did that weigh into your delivery?
Those contracts just ran 230 apiece.
Release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Nick Timmeros with Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move.
Nothing is happening.
It's enabled us to see more data, and it will continue to do so. We really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along
feels
with
like a lot of downside. Look at this upper wick. It feels like we're going to break down.
Was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that. That a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off.
None of these moves hold. You got to be in and out if you're playing it. I'm staying away for now. Nothing holds, no matter which way it goes.
Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be.
He's stoked cold. He's in there. He's like, I don't give a fuck what any of you say. I'm just going to continue to stick to the script.
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Hi, Chair Powell. Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the summary of economic projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market.
You got to be in and right out.
Raise rates by 5 percentage points.
Be careful if you're trading
in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than
some of the other things like Microsoft and Tesla are probably a good look,
are still very, very high. We see by surveys and
SPY and SPX pretty tough right now.
That conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that
41.55 calls is what I'm looking at right now.
In the labor market,
doesn't feel like it's going to break down. This is the 5-minute.
Yet,
15-minute is all over the place.
Been moving down. Wage increases have been moving down, and that's a good
1 hour is not really showing
down
much.
To more sustainable levels. So I think it's still possible.
Everything
think,
does look kind of weak.
The case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March
I wasn't very bullish.
Wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that
covering his own
ass
is
really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward?
I think I'm going to try some puts up here, just a quick scalp.
What you think is going to happen?
Of them.
Are you ruling out
put like $100 stop loss on
the
it?
Market has priced in.
Didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean,
here we go.
We look at a combination of data and forecasts. Of course, the whole idea is to create
make sure
a good
it's not like
forecast based on
massive breakout.
data. So we're always looking at both, and it will, of course, it'll be.
I'm gonna sprinkle here a little bit.
Readings on inflation. It'll be readings.
If it gets above 413.50, I will be out.
Growth on the labor market. And all of those many things.
I'm lagging a little bit.
Particular focus for us going.
Not going to play a lot while I'm lagging a lot.
6-7 weeks now.
Almost got it at 110. I don't know what happened.
Is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards? And is that having an effect on?
That is crazy.
On loans, on lending.
They were.
And, so we can begin.
What a quick
to
old
assess,
$200.
How that fits.
Nothing from me just yet until
that'll be an important.
I think that it's causing the stream to be real slow with Powell up here as well. So
again, I would just point out we've raised.
Would have been a good idea though. It'd been $80 a contract there.
We are shrinking the balance.
Not more. Probably would have held them
now
too.
We have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to
every pop up gets sold off. I think I'm just going to scalp each big ass move like that.
Make our assessment of.
Damn, man, that would have been
whether our policy
$240 trade.
And we have to do that in a world where policy works with long and variable lags.
That would have been over 100%. That is crazy. But it did not hit me at 110.
That's what we're thinking.
What about the idea of rate cuts?
Hope you guys saw that, because that's fucking vicious. That would have been a $400 trade right there, just on 2 contracts.
Have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in.
That hurts bad. I would almost bottom tick that. That would have been a $600 trader here.
We'd factor that in, but that's not our
just
forecast.
On 2 contracts.
And of course,
$200,
the history of the
$600.
last 2 years has been very much.
I think I'm going to take the calls here because it keeps bouncing back and forth.
If you look at non-housing,
not
services,
4100s though.
It really hasn't
4150s,
and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view
I'm in one call right now, nothing crazy. If it breaks down below this, I will be out like $50.
Stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits?
15-minute looks weak here.
Did the committee discuss any?
If it breaks below 410.40 or 410.50, I'll be out right here.
Table in the future. Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year,
I got to stop at 140, $60. Stop out on
every tightening cycle. They've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
I'm only in 2 calls, but See if we can get one of those random bounces.
I want to go back to the debt ceiling for a moment. I know you're
No,
talking
it's a $100 loss.
Fiscal policy.
Jesus
but can you
Christ,
just speak
man.
towards what the impact of a default would mean for Americans across the country, the
Well,
markets,
$200 that we were out so far.
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can do. Can really protect the financial system and our
Chop is
reputation
crazy.
globally from the damage that such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair
Looks like we got the sell signal.
of factors that he thought
Look at, remember this
contributed to
this support line I have a 408.
supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from.
I think we might have caught that
and also
direction that we
call
want.
A sort of cultural shift.
We only have 50 minutes. He's got to get off the
towards
mic, man.
Less aggressive
Causing way too
oversight.
much volatility.
You were here in 2019. Do you share that view? And
Get out.
what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system.
Wow, those 4100s I tried to buy at 110 ran to
only
700.
That I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. You know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is to identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those
Look
have
at
now
these
all
4100 puts,
all the
man.
depositors
They went
have
from
been protected.
110
I think
to
that the
70.
resolution and sale of
That is
First
crazy
Republic
to me.
kind of draws a line under that period.
Look at this little
of,
resistance, the
important
support
step
line over here,
drawing a line under
4089.
that
I actually
period
might
of-
have to
of
take
severe
those.
stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the.
If I can get a little buy up here, I might take
we'll see
them.
in the sluice is small and medium-sized, small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor.
I don't know why it doesn't let me in half the time.
And we'll factor that assessment.
So every time I
into
live
our
stream, it
decisions
doesn't
in an
fill me.
important way going
It's another
forward.
$60 that could have been up. It's hard for me to buy a lot of contracts when I'm on live.
Thank you, Fed Chairman.
Just lags like
Greg
crazy.
Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been
Terrible
chair of the
question.
board for 5.
This is ass. And he's causing a lot of volatility. I can't listen to that anymore. So I'm going to get out of that shit. I'm going to try to trade this volatility without listening to that. Hopefully it can speed up my entry points over here. It feels like it's a little bit better now that I'm not watching that live stream while live streaming. It's pretty wild. But I was trying to get in here. If you guys noticed those $4,100 puts, at 110. It did not fill me and then instantly ran fucking all the way to $800 a piece. So that hurts. It looks like we have that downside direction right now, but I want to be very careful because I have seen this thing just rip like crazy all the time, but it kind of feels like we have that direction right now. The downside, if you look at the 15-minute and 30-minute, there is a support line around this 4,100, and then below that, we have that 4090 bounce from yesterday. So that's what I'm trying to play now. I feel like now that we have this downside, if I can get like a little bit of a green candle, I might try to play some puts. I don't want to buy the bottom of this because obviously you've seen how fast these things can get shredded. 460 all the way down to 60 cents. So I don't want that to happen. I missed that top up there. That's really, really frustrating because that was the payout. I only was gonna have two, so I can't be that mad. But that's still $1,000 off of $200, which is really frustrating. Even more, I think it's like 1,400. So that's a tough part. That's a tough pill to swallow. But I am just waiting right now. I feel like there is some good opportunities still to get involved in these. I'm down about $400 right now off of these chop trades. I'm trying to get more than 2 contracts because I love the volatility, but I hate the chop back and forth. So I'm going to need to see a little bit better of action here, except I don't want to chase. That's the problem. So if I chase the downside and we see one of those big-ass green dildo candles, that's going to be pretty tough to watch because my max loss is going to be 500 on this trading account, like I said. Yesterday we were up about 400 something or 350 or 400 or something like that. So the max loss will be 500 every day on the live trading account. I probably should have stopped dabbling with SPX contracts while the conversation was still going on. But I am watching for this little bit of a run up. Maybe we can get some downside action, but that's exactly why you don't chase. So we go from 500 to 235. And these are the 4090s. So be careful. It is at the bottom of a Bollinger Band, but I do see some downside. This does look pretty bearish to me. We did just tap that 4115, which is now acting as resistance down here on the SPX, and we got rejected. So just got to be sure that it's not going to continue up a little bit here. It starts getting weaker. I will buy some for the rejection. It is on the bottom Bollinger Band, so we might have to wait towards this level around the 411. And then I might try to dabble in the 4090s for the downside. 4100s actually might play a little better just because it's so late in the day. Down to 430 from 900. I wouldn't buy as many of these because they could pay 500 a contract on a breakdown here, so I don't want to go too heavy. We're in the middle of a bounce play right now. I want to see some more weakness. That's my goal. I think I might set a limit order down here at like 280 just in case we do pop. Doesn't feel like we're going to pop and start ripping because there's only 40 minutes left in the day. It kind of feels like it's heading towards that direction. Headed down. These scalps are nuts, Zach, like literally crazy. These things are going up and down $500, $600. I've even only bought 1 to 2 contracts and I'm still down 400. It's pretty crazy. So I really want to get one of these because look at how much they pay. I'm thinking about going in on 5 to 10 contracts here because that could be a massive payday, like 3K to 900 right here. Real fast 6K walk away would be massive, but these scalps are really, really tough. So got to be in because the stop loss can boom you in a second. I still feel like downside is coming, but I might flip to the 4090s because I'm looking at this, like if I zoom out here on this 15-minute chart, yesterday's low right here was at 4090. I really kind of feel like we're going to test that. But I am scared of the volatility today, especially so late in the day. And already being down 400, I don't really want to go that heavy. A little bit freaked out. Made 3.5K, but we need to be in and out. Locked in some profits. Zach, beautiful. Beautiful trade. I haven't gotten one yet today. I didn't even really trade my large account. Today I caught Microsoft a little bit. It was only like $50 a contract. A little heavy size, but nothing crazy. I think I'm going to go in one here, the 4090s. And it's not filling me again. I'm having so much trouble getting in these, man. I'm trying to go with the momentum, but I'm lagging like a motherfucker. $285. Like, I just tried to catch that 285, and there's the downside. You guys are seeing how delayed this is, I hope. It's really tough to... I don't know why. It's not my Wi-Fi connection. I have full Wi-Fi connection. I don't know what's wrong with it. It's trying to bounce a little bit here. If I'm going to get in, I should probably get in like right now. At 320, I don't really want to get in this low or this high. I guess this low, but the price is this high at 350. But I mean, these contracts could be worth over 1,000 a piece, no problem. You're having issues? Okay, all right. I thought it was just me. I was like, why am I lagging so bad right now? $409. Yeah, guys, I feel like, let me look at this daily chart real quick. We could have a massive collapse here in the next 40 minutes. And if everybody's having lagging issues, it could be the whole market. So 407, 408 area, another dollar drop down, and then I could see another 406-ish area. Is anybody else having? Yeah. I am not using an Ethernet cable, but I'm going to go get that very soon. And there's the drop. It's frustrating. Just losing money for no, I can't get in anything. I've tried 100 times. That's crazy. Even 2 contracts would have paid $400. Would have been flat right now. We could have went crazy. I feel like these are even going to drop even lower to this 408 level, and then I have a support even further down than that at 404, which I'm not counting this out whatsoever because I think this 408 level is about to be tapped. And then we're going to hit this low of the day from yesterday, 40.90, but it's only 10 cents down. These contracts are fucking printing. Dang it, guys. Dang it. I want in so bad, and if I chase, I'm going to lag, and it's going to get me a bad fill. And then it's going to bounce on me and stop me out, and I'll be even more mad. All right, I'm going to try one time at 420 here. It's still trying to get in. It's like not even registering it. It just now registered. Yeah, I'm having a lot of trouble, guys. I think I'm gonna have to get out of this, and now it's gonna bounce. Brutal, brutal, brutal. I'm gonna take a 150 loss here and just I gotta stop trading because it's not registering anything for me. Wow, that is crazy. That's very, very bullish too. Red to green. I feel like it's gonna spike up. I can't get any action out of this. So I'm gonna call it. I'm gonna call it my day. I'm gonna lose that 550. I'm gonna stop streaming. I'm gonna try to make it off the stream because I just can't get good entries. It lags way too much. I think you guys can see that right now. So I don't know why this happens to me some days when I hop on here. It lags like only some days. Like yesterday I was just fine. It was a little slow, but it didn't lag that much. I tried to get in this entry for this reversal. It didn't fill me for some reason. Completely tanked. The contracts ran about $900 a piece. And anytime that I was getting involved, it kind of filled me much later. And anytime I got in, it was going to stop me out. So I'm going to try to make this loss back real quick with some size, but I'm going to have to go off the live just because it is a $550 loss. So I'm going to have to go in with some size real quick at the end of the day. But I need to have my connection in order to be able to trade it. So I won't be able to do this very live, but I do see a very big support down here at this level. I don't think that we're going to continue to bounce, but I'm going to go with the momentum. But I mean, these contracts are moving like crazy. So if you're on the right side of them, you're going to get paid. I think I'm going to play the downside. I'm going to play this rejection around 411 for the downside, but I'm going to have to hop off. Lag issues on multiple trading platforms. That's crazy. But love you guys so much. I got to get involved. So I'm going to go play puts, but I have to hop off the stream so I can make some money.